Area 10.
My name is Hubert Vos. I'm from Santa Barbara, California. Earlier this morning, you made a comment that if the market fell, you would be spending less time on the internet because you'd be very busy. And this has reinforced an impression I have had that the cash flows of Berkshire Hathaway are enormous, but that possibly in the last 12 months, you've been investing less than you had previously. And if so, if this is correct, what does that say about waiting for attractive values? How long are you willing to wait? And what does that say to the investment public in their own habits?
Well, you're correct that we have not found anything to speak of in equities in a good many months. And the question of how long we wait, we wait indefinitely. We are not going to buy anything just to buy something. We will only buy something if we think we're getting something attractive. And incidentally, if things were 5% cheaper, or 10% cheaper, that wouldn't change anything materially. So we have no idea when that period ends. We have no idea whether on equities stay where they are, but they are, even then they aren't in the least mouth-watering. So we won't feel we've missed anything particularly if returns stay where they are, because if it turns out that these levels are okay, they still will not produce great returns from here in our view. That doesn't mean you couldn't have a tremendous market in the short term or something of the sort. Markets can do anything. I mean, you look at the history of markets and you just see everything under the sun. But we will not, we have no time frame. If the money piles up, the money piles up. And when we see something that makes sense, we're willing to act very fast, very big. But we're not willing to act on anything that doesn't check out in our view. You don't get paid for activity. You only get paid for being right. Charlie?
Yeah, an occasional dull stretch for new buying. This is no great tragedy in an investment lifetime. And other things may be possible in such an era too. I mean, it isn't like we have a quiver with only one arrow.
We sat through periods before. I mean, the most dramatic one being the early 70s, late 60s and early 70s. For a long time, it doesn't seem so long when you look back on it. It seems long when you're going through it, but it's like having a tooth pulled or something. But it's, what can you do about it? The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like. We'll love it when we can swing in a big way, though. That's our style. Area 1?
Larry Pitkowski, Millburn, New Jersey. Berkshire seems never to have made any pure real estate investments, with not counting facilities the operating companies might own, with the exception of Wesco's involvement in the residential project in California. I was wondering if you've ever looked at a real estate transaction and tried to apply the same filters, meaning competitive advantages, returns on capital, that you do in operating companies. And if not, is it a circle of competence issue, or is there something you find disinteresting about real estate?
You want to take it? Okay, Charlie wants to take this one.
Let me take this one, because here's a area where we have a perfect record that extends over many decades. We have been demonstrably foolish in almost every operation that had to do with real estate we've ever touched. Every time we had a surplus plant and didn't want to hit the bid and let some developer kind of take an unfair advantage of us, we would have been better off later if we'd hit the bid and invested the money in fields where we had the expertise. That housing track that I developed because I didn't want to let the zoning authorities rob me the way they wanted to. I wish I had let them. We have a certified record of failure in this field.
And the funny thing is we understand real estate.
Yeah, and we're good at it.
actually is correct to say we do understand real estate, and Charlie got to start real estate.
Yeah, but we understand other things better, and so the chances that we're going to be big in real estate are low.
Yeah, we've seen lots of things, and the prices just don't intrigue us in terms of what we get for our money. I tried to buy a town when I was 21 years old. The U.S. government had a town in Ohio for sale, and would have worked out very well. There's nothing about the arena that turns us off, but we don't see great returns available, and like Charlie says, the few things, particularly having an old plant or something, we have not been great at working our way out of those. Fortunately, they haven't been very important in relation to the net worth of Berkshire. Area 2.
Good afternoon. My name is Fred Castano from Detroit, Michigan. My question concerns Nike. Nike is a company experiencing some short-term problems, but is a great company with an excellent track record. Phil Knight is similar to Bill Gates in the respect that he's a marketing genius and is a very hard worker. Making sneakers is a very simple business with high margins. How do you view Nike, and what do you think of the company?
Well, I think Phil Knight is a terrific operator. I think, and he's a competitor. He's got a lot of money in Nike, but in terms of what we think of the stock, we keep all of those views to ourselves pretty much. Area 3.
Hello, my name is Ed Clinton. I'm from Chicago, Illinois. I'm wondering about the tobacco litigation. There have been some comments about fatty food. Do you think there's going to be a new trend of fatty food litigation coming out of the tobacco problems?
Well, I sign a waiver before I do any of that myself. No, I would doubt. I do not see those two as being remotely similar. But, Charlie, do you have any different views on that?
Well, I think the traditional tort system is particularly ill-suited for solving what might be called the tobacco health problem. So I regard that whole thing as sort of a Mad Hatter's Tea Party. And we sit out from afar.
Number 9.
Yes, my name is Steve Check. I'm from Southern California. And my question has to deal with kind of quality versus price. I've been to 3 annual meetings and I've heard great things about Coke every year. But as far as I'm aware, you have not bought any additional shares of Coke over the last 3 years, even though the stock has done just fine. If an investor has a relatively short time frame, say 3 to 5 years, how much weight do you think one should give to quality versus price?
Well, if your time frame is 3 to 5 years, I wouldn't advise it being that way, because I think if you think you're going to get out, then it gets more leaning toward the bigger fool. The best way to look at any investment is how will I feel if I own it forever, and put all my family's net worth in it. But we basically believe in buying, if you talk about quality, meaning the certainty that the business will perform as you expect it to perform over a period of time, so the range of possible performance is fairly narrow. That's the kind of business we like to buy, and all I can say is that we like to pay a comfortable price, and that depends to some extent on what interest rates are. We haven't found comfortable prices for the kind of businesses we like in the last year. We don't find them uncomfortable in the sense that we want to sell them, but they're not prices at which we added to Coke one time about, 5 years ago or thereabouts, and it's conceivable we would add again. It's a lot more conceivable we would add and subtract. But that's the way we feel about most of the businesses. We did make a decision last year that we thought bonds were relatively attractive, and we trimmed certain holdings and eliminated certain small holdings in order to make a bigger commitment in bonds. Charlie?
Yeah, you talk about quality versus price. The investment game always involves considering both quality and price, and the trick is to get more quality than you're paying for in the price. It's just that simple.
but not easy.
No, but not easy.
Area 10. Area 7, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Keiko Mihalik, and I'm an MBA student at Wharton, but please don't hold that against me.
We won't. I never made it that far. I was an undergraduate student.
Could you please explain how you differentiate between types of businesses in your cash flow valuation process, given that you use the same discount rate across companies? For example, in valuing Coke and Geico, how do you account for the difference in the riskiness of their cash flows?
We don't worry about risk in the traditional, the way you're taught actually at Wharton. But it's a good question. Believe me. But if we could see the future of every business perfectly, it wouldn't make any difference whether the money came from running streetcars or from selling software, because all the cash that came out, which is all we're measuring between now and Judgment Day, would spend the same to us. The industry that it's earned in means nothing except to the extent that it may tell you something about the ability to develop the cash, but it doesn't tell you. It has no meaning on the quality of the cash once it becomes distributable. We look at riskiness essentially as being sort of a go, no-go valve in terms of looking at the future of businesses. In other words, if we think we simply don't know what's going to happen in the future, that doesn't mean it's necessarily risky. It just means we don't know. It means it's risky for us. It may not be risky for someone else who understands the business. In that case, we just give up. We don't try to predict those things. And we don't say, well, we don't know what's going to happen, so therefore we'll discount it at 9% instead of 7%, some number that we don't even know. That is not our way to approach it. We feel that once it passed a threshold test of being something about which we feel quite certain, that the same discount factor tends to apply to everything. And we try to do only things about which we're quite certain when we buy into the businesses. So we think all the capital asset pricing model type reasoning with different rates of risk-adjusted return and all that, we tend to think it is, well, we don't tend to, we think it is nonsense. And but we do think it's also nonsense to get into situations or to try and evaluate situations where we don't have any conviction to speak of as to what the future is going to look like. And we don't think you can compensate for that by having a higher discount rate and saying it's riskier so that I don't really know what's going to happen, I'll have a higher discount rate. That just is not our way of approaching things. Charlie?
Yeah, this great emphasis on volatility in corporate finance, we just regard as nonsense. If we have a statistical probability of putting out $1 million and having it turn into put it this way, as long as the odds are in our favor and we're not risking the whole company on one throw or anything close to it, we don't mind volatility in results. What we want is the favorable odds. We figure the volatility over time will take care of itself at Berkshire.
If we have a business about which we're extremely confident as to the business result, we would prefer that it have high volatility than low volatility. We will make more money out of a business where we know where the end game is going to be if it bounces around a lot. I mean, for example, if people reacted to the monthly earnings of Seas, which might lose money 8 months out of the year and makes a fortune, in November, December. If people reacted to that and therefore made its stock as an independent company very volatile, that would be terrific for us because we would know it was all nonsense, and we would buy in July and sell in January. Well, obviously things don't behave that way, but when we see a business about which we're very certain, but the world thinks that that its fortunes are going up and down, and therefore it behaves with great volatility. We love it. That's way better than having a lower beta. So we think that we actually would prefer what other people would call risk. When we bought the Washington Post, I've used that as, it went down 50% in a matter of a few months. Best thing that could have happened. I mean, that doesn't get any better than that. Business was fundamentally very non-volatile in nature. I mean, TV stations and a strong dominant newspaper, that's a non-volatile business, but it was a volatile stock. And that is a great combination from our standpoint.